Well, welcome, James. We're very pleased to have you as our guest on Ask the Expert with Third Party Risk Institute. I'm Linda Tuck-Chapman. I'm CEO of Third Party Risk Institute, and this is a monthly series. I just wanted to forewarn everyone that we do record the series, and it will be available in our resource center, and we also make use of it as will Rapid Ratings on social media. Without further ado, James is the CEO of Rapid Ratings. And Rapid Ratings, I have to tell you, James, I'm still a huge fan. And I very, very often recommend you to clients or colleagues who are interested in knowing who has the best risk intelligence solution out there for financial health. And I have to say, you've done an amazing job. So this is not just pure flattery, and I know you're not paying me, but I really feel very strongly about this. So if you could tell us a little bit about yourself and about Rapid Ratings and why you are different, how you happen to have such a good product, that would be great.
Well, first of all, thank you. I appreciate it, and the admiration is mutual, as you know, Linda. And for those of you who have joined, I appreciate it. And I mentioned to Linda offline over the last couple of days that I learn something every time we get the opportunity to talk, and it's always invigorating to be able to speak with someone who's as established and knowledgeable about the space. So I appreciate your asking me to be on, and very happy to be here.
Okay, perfect. Okay, so Rapid Ratings, you've been around for a number of years now. I can't remember when your company started, but I bet you know.
Yeah,
so,
we've been around about 15 years. My longtime business partner and I, Doug Cameron, we bought the technology and incorporated the original founder and architect of the system, Dr. Patrick Carragata, in sort of a restart of the company about 15 years ago. And my background is originally as a banker, then as a technology entrepreneur. And what we saw in the original configuration of the system was an ability to look at companies' financial health, and we can talk about what that really means, but an ability to do it algorithmically, so not having to incorporate human analysts who often will have some bias or communication with management of companies that can change the nature of their ratings, a la the traditional rating agencies. But also a system that used actual financial statements from companies to evaluate them on an apples-to-apples basis, regardless of what industry they're from, or whether they're public or private, or where they're from in the world. So really a way to create apples-to-apples analyses of companies of any kind from anywhere, and to do it on a consistent in a very analytically rigorous basis. And we loved that conceptually, and we've been building out applications and products around that really ever since.
Well, what a novel concept, actually analyzing financial health from financial statements. Who knew that was possible?
It's amazing how sometimes we have to use a lot of technology to do something that sounds unbelievably simple.
But you know, there's a lot of truth to the bias that goes into the analysis. I mean, at one point in time, I actually was a banker. And you're right, talking to the company gives you perspective. But in the case of pure quantitative analysis, that really shouldn't be happening. Now, what we do rely on, of course, in third-party risk management is providing quantitative data as well as we can through our processes to risk management specialists, so that they can then apply their own expertise, which is the qualitative side of things, to look and see if it makes sense in the context of their organization and in comparison with other companies they might be doing business with. And that's the beauty, actually, I think, about the more quote unquote modern version of third-party risk management. There's much more reliance on quantitative analysis, and most companies have realized they need to move away from the qualitative, because there's just, if you had a bad day yesterday or a risk event with someone in a similar circumstance not too long ago, you will be influenced by it. It's inevitable. We're all human. So anyhow, yeah.
I think people are influenced that way, and that doesn't mean their knowledge or their personal experience isn't good or valuable, but it isn't scalable. And one of the big challenges that's happened over the last, and opportunities that's happened over the last decade to 2 decades, is that more companies themselves are global, and the suppliers and vendors that they work with are more diverse and geographically spread as well. So one can have a lot of expertise in analyzing a particular kind of company, but
Mhm.
when they need, for whether it's regulatory purposes or for just best practices and operational efficiency purposes, when they need to be evaluating lots and lots and lots of companies and to be able to do it at scale and have it be predictive, not just box checking that they've done something, then the human capacity to do that is limited. And no one has the budget to just continue to hire people to analyze companies. So there has to be a way to leverage technology. And I think we've really tapped into that in a lot of ways to be able to give scalable yet very analytically rigorous insights into companies from around the world has made it a real, is given people leverage to then, as you say, put their own qualitative understanding spin or the nuances for the kind of business relationship that they've got with a company to bear to make that last mile decision.
Well, I have to say that the word predictive really piqued my attention here in this conversation because, part of the challenge is that the last few years have been certainly turbulent, if that's the right word to use for it. So the analysis is typically done on a historical basis, right? You're analyzing financial statements for what has gone before, but now you're talking about predictive analysis. So can you just tell me a bit more about how you marry those two concepts up?
Sure. And I think historically, people have thought historically about financial statements. They've thought, well, this is a reflection of what a company did before. But if you use the metaphor of human health
Mhm.
and you think of it in terms of corporate health or financial health, you start to appreciate that there's a lot more to it in what you can see going forward and how well positioned a person or a company is to weather a storm going forward. And for instance, if you look at a checkup for a person when they go to the doctor, that's not just saying what their health was in the past. It's saying what their health is today and what that means going forward to a degree until something
Oh,
or if
I love
something
this
happens
answer.
to
Actually,
change.
such a great analogy, James, because you're quite right. When you look at health, for example, and we're talking about financial health, but when you look at health in general, basically, I've been doing yoga for like a lot of years, and so that actually, as basically as you get older, your past behavior does help to predict the future. And if
Absolutely.
yeah, because basically, lots of people sort of get religion on the health side when they start to have health problems, and it's a little late. So
Well,
anyhow,
and if
so
you
yeah.
if you think about the COVID crisis as being this catalyst for change for a lot of companies, but also just this shock to the corporate system, um, continuing the metaphor, a human was most affected by COVID if they had a pre-existing condition, if there was a respiratory problem, whatever it might be.
Mhm.
The people who were healthiest were able to get COVID and survive it with minimal impact to them for the future. A corporation is very much the same. A company that is financially healthy has the ability to weather a shock, regardless of whether that shock is by something they may do or some exogenous outside factor like cost of oil increase or access to capital challenges or whatever it might be. But a company that is strong and or is strengthening is in a better position to be a good partner and in a better position to do all the things you want from a good partner than a company that's weak or weakening. They're the ones who are going to have a bigger challenge. And what we found, what we thought originally when we saw the technology that is now Rapid Ratings and what we see with our clients every day is that the predictive nature of what we do is looking at a company's financials. And then we're essentially profiling that company and comparing it to now 14 million company years worth of financial data and saying, how does this company look relative to other companies that have gone before? How does it look over the next few years? And so by that, in that nature, we're able to give a predictive view of how a company is faring and therefore whether they're going to be a good third party partner to a business.
Well, and that's how banks lend money. That's how you decide whether your company is going to extend credit to another company. So this is all making a lot of sense to me. Now, when you start to think about sort of what's happening in the world with third party, one of the things I often see with my clients is that they really only check the financial health of their most important third party relationships, which are typically with very large firms. So, what are your thoughts about what part of the population should be subject? What part of the vendor population or third party population should be subject to a financial health check, and how often should you check?
Well, so there's a lot to that.
Yes, sorry, that's a big question. Like
No,
lots of
no,
questions.
that's good. We can break it down.
Okay.
So for starters, I think every business needs to think about their third parties in terms of criticality and impact. And that doesn't necessarily equate to how much they spend with those companies. It
Yeah.
very much has to do with what can those companies do to your business, and does a third party affect your reputation if something goes wrong? Can it affect your internal technology or PII that you may have? Does it affect could it be $200,000 you spend with them, but geez, if they fail, it's going to cause you $10 million worth of damage and lost business or fines or whatever else it may be. And change management, when people move from a critical supplier, can be extremely expensive, very distracting, takes a lot of resources, and it's best avoided. So measuring criticality in understanding a supplier base or vendors, third parties, is really important. And focusing on the most critical and being able to allocate budget, frankly, and internal resources to be able to look at them is the number one most important thing. It shouldn't necessarily equate to spend.
Yeah, music to my ears. I'm so big on relationship segmentation. I've been doing third party for at least as long as you have been in this business as well. And I must admit, it was relatively early days. I don't think in the beginning, when I first started in third party, I was separating these two concepts of criticality from exposure to risk or impact. But it didn't take me long to get there, because it's hard to explain to yourself why you're doing certain things for one third party and not another, or how much time do you spend on this, and all those types of things to consider. And I think that fundamentally having a very strong relationship segmentation framework that allows you to clearly separate the two concepts, and then to be able to have some perspective around them, around importance or risk. And when you put the two things together, it ends up being a matrix, not a graph. And that way,
totally agree.
Yeah. And that way, I think that this is how we sort of back into what part of the population should you pay attention to. I mean, in my mind, basically, any company that's worth putting the resources on to conduct, extensive due diligence, and to, put a lot of resources on management, et cetera, because you are dependent on them, right? You are reliant on them being there for you. And so if I step back and look at my practice, what I've seen, it hasn't changed for quite a few years. The top three things to focus on are cyber. It never gets old. Basically the whole idea of business continuity management. Are they going to be able to meet your expectations there? And the third one has been financial health for as long as I can remember. Because, without financial health, yes, they can cause you a lot of problems by doing things wrong, but it's also a missed opportunity in terms of them doing things right. I mean, one of the things I always look for is whether or not they actually have any track record in investing in themselves and innovation or new platforms or, new ideas. Because as your company change, you want to make sure they change with you.
So. Absolutely. And also there's a to that point, Linda, I think there's too much focus, or rather there's a path dependence, there's inertia in the way people have managed risk before, where they tend to silo the risk management components and they don't think about how these things interconnect. And so just taking the ones that you've just mentioned, most of our clients, and we certainly believe that there's an interconnectedness to these risk areas, and that financial health is an underpinning one. And if you just think about cybersecurity, it's been an incredibly important one and will continue to be for quite some time. But a partner, a supplier or vendor that is weakening in financial health is not going to be able to invest more than they have historically in cybersecurity, and they may be cutting corners. Now, those corners might not be dramatic, but they could be things like, they had plans to hire a new compliance person, so they had two compliance people instead of one, and they decide, well, we don't need to do that right away. We can push that off by a couple of quarters. Or things like, they're spending so much money and they're audited by their clients on cybersecurity investment. So the newer things that they are being asked to do, like ESG investment, they may say, yeah, we just don't have the wherewithal to do that right now because we have to make payroll. And so we're going to put that off. And the promises that they've made, and therefore the promises their clients or customers have made about, and representations about the ESG investment of their supply chain, all of a sudden becomes disrupted. But the biggest and the worst is when companies become less innovative, when they become less of a good partner because they have to delay the investment in research and development, and so they kick out new product, and that comes out a year later instead of a quarter later, and all of these things that go to having really strong, resilient suppliers in a resilient supply chain become disrupted when there's financial health degradation. But the flip side, as you just touched on as well, is that when you have a strong, financially healthy supply chain or ecosystem of suppliers, it's more dynamic and it can grow with your business when your business has the opportunities to grow. And so you want to be able to manage the downside risk, but you also want to be able to create as extensible and flexible and agile of a supply chain and third-party group as you possibly can. And financial health underpins companies' abilities to do all of those things.
I totally agree. I do want to make a point. This is different than some of the other risks that you see in third party. In many, many cases, we're evaluating third party controls. This is different. We're evaluating actually their actual performance, their financial performance. And I just wanted to note that, in case anybody's wondering, I don't typically roll the financial health rating into the overall integrated aggregated residual risk rating. And there's good reasons for that, right? I mean, the financial health of companies can change fairly quickly. And it's an indicator of their ability to be there for you and to grow with you and all those types of things, as opposed to specifically a control. And that's why I think if you call it out separately, it's something to evaluate whether you're going through contract renewal or whether you're going into a new relationship, because it's never, ever going to be a once and done. So,
that's right.
Anyhow,
and there are different times in the life cycle of a third party that you want to do more or less. And you asked before about how often to do financial assessments, and I think financial assessments should be done at the outset of a relationship, maybe even at the sourcing event when down selecting into a couple of potential new suppliers for something. But then also the continuous monitoring. You may not need to do everyone on a quarterly basis. You do them on an annual basis. But when there are risks that appear in some other control area or risks that appear in the financial area, that's when you would want to do more of it. But depending on the life cycle and where you are and what other controls you're looking at, you may want to do more or less.
And back to that criticality or the relationship segmentation matrix. Okay, I do have some specific questions that were submitted. So the first one is from Javon. Hi, Javon. So his question is, does Rapid Ratings have plans to expand the scope of risk services to include other risks such as ESG, cyber, et cetera? And if not, do you have partnerships with other companies that are covering those areas for you?
I'm glad you asked about the partnerships part too, because there's always a desire to do more things because our clients do a lot and want as broad inputs as they can get. So we are looking at what other risk domains we could cover as well, but we're very self-aware that in financials, we believe we are the standard now, and that we have become that by being hyper-focused on delivering the best analytic possible. That comes from having an enormous amount of historical data. And you can't get that same comparative data on most other risk domains. So our going into those would mean doing something that has a very different approach. But we do look at it. In the meantime, we have a very strong partnership group, and those partners span environmental and sustainability ratings, cybersecurity ratings, compliance, as well as platforms that are aggregating internal and external data into scorecarding that allow people to manage risks across a whole variety of different lenses. So very happy to talk to people about the companies that we would recommend in our partnership group, and anyone can feel free to reach out to us, and we'll recommend the companies we think do a really good job in different domains.
And that in itself is a hugely valuable service. I often get asked, we have the Certified Third-Party Risk Management Professional Program. It always comes up in conversation with what platform are you using? Which risk intelligence solutions do you recommend? And, we at Third Party Risk Institute, we're happy to recommend where there's a good solution. So I don't know if you call yourself this. I don't know if other people use it. I call your service risk intelligence. So
I like it.
Okay, perfect. Because I was always struggling trying to figure out what to call things like, cyber alerts and those types of things. And risk intelligence solutions is really what you do provide. You're part of that network. So anyhow, so Joanne, I hope that answered your question. I thought it was a very good answer. Thanks. Okay, so this one is from Kenya. And Kenya has asked us, how do you see financial health as service providers influencing concentration risk analysis?
Oh, that's
a tough one. Thank you, Kenya. That's hard.
So I'm not sure that it influences concentration risk in that our higher ratings on companies are making people concentrate more on individual third parties. There is some of that. I don't think we're creating systemic risk because of that. But the topic of concentration risk is a absolutely fascinating one, particularly right now with a lot of the Silicon Valley Bank and bank crises spillovers, because concentration risk is one of the big issues that SVB was faced with in its depositor base. And it also gives what I think is a really important lesson to everybody in third-party risk management, and that's that the third parties people are working with are often highly concentrated in the third parties that they may be exposed to for things like capital. And just as we saw that a huge percentage of technology third parties that people work with had as their only bank Silicon Valley Bank, and therefore their ability to access deposits, 2 weekends ago, the concept of how exposed they were going to be on Monday, that was a radical sort of eye opener for a lot of people. And when you extend that out to thinking that a lot of those companies only get their financing, only borrow from one bank. If that bank is in trouble or that bank's credit standards change due to regulatory oversight or something else, all of a sudden access to capital for those companies becomes at greater risk, which is a major theme right now that everyone needs to be focusing on. So the issue of concentration risk question, I think, is a really interesting one and extremely timely.
It is. So I did a white paper a while ago on concentration risk. I like doing that because it makes me learn, right? I can't write about stuff I don't understand. So what we learned when we did that, there are different types of concentration risks. You mentioned entity level. So entity level is really all your eggs in one basket with the same third party. And when they're in trouble, you're in trouble, right? So activity level is kind of interesting as well, where you might have, following with the bank example, let's say that you have heavily outsourced one of your product lines. Like when I was with a bank, we outsourced pretty much everything on student loans. We funded it and we kept the name, and everything else went out. So that's an example of activity level concentration risk. And then there's geographic, fourth party, and I forget the other one off the top of my head. But it's interesting because financial health, it's inseparable from everything that you do. So to me, yeah, it does influence concentration risk, because if you're highly concentrated for something, you better have a close look at those third parties. And especially if it's a major revenue generator or something that's essential to your organization. Yeah, I would say that financial health is going to influence your thoughts on concentration risk big time. And if it doesn't, it should. So that was Good question.
And Linda, maybe this is probably a very personal comment, but as an entrepreneur, sometimes you're faced with opportunities, or you should have the need to reflect on doing what the consequences are of your business. And we have long felt, and I've tried to instill this in all the members of our team, that we have a really important responsibility, because we are rating companies, some of which are early stage companies, and they have people running them who started them who are as passionate as we are as entrepreneurs. And a poor rating can affect them, and it can affect who wants to work with them, or the nature of the work that they're doing with them, or the quantum of work that they're doing with them. And so we've taken that to heart, and we really try extra hard to be communicating a couple of things. One, a poor rating on a company doesn't necessarily mean they're a bad company to work with. Often it doesn't. It may very well mean that they are at a point in their life cycle where one needs to ask them different questions to work with them. One needs to be more collaborative with them, that their transparency in sharing their financials and other information on cybersecurity readiness, or whatever it may be, is all part of the texture of the relationship and the collaborative nature, and that there's commercial value to that. And we espouse that in a way that we hope is additive, because we realize that we have a very important fiduciary responsibility, because we're rating these companies, and those ratings can be used to give them more business or less business. And if we're rating one company many, many times for different clients, there can be a cumulative effect. So we do think about this in a lot of different ways.
Well, and you're leaning into the whole question of these younger companies. They just don't have all of the creds that companies are looking for. They can't answer half the questions on the due diligence on other areas. And when it comes to financial health, they're not going to be like a Fortune 500 company where you can go and look at their 10K and they can do analysis and you can keep an eye on them. So how do you handle those ones? Because that is such a challenge for just about everybody in third-party risk.
Well, for starters, there's getting access to the information. And every company, unless they are truly in the garage and only a couple days old, they've got financial statements. They may not be audited, but they've got financials. And we are rating companies that have $1 million in revenue, sometimes less than $1 million in revenue, so very early stage companies. The bulk, of course, is larger than that, but we do rate those as well. But once a company has disclosed financials to us, they're doing it confidentially, and they're doing it on behalf of, or we're doing that. We're collecting it on behalf of a client. We may do it multiple times for different clients, but we're doing it for a client that wants to have a relationship or has a relationship with that private company. And that private company is recognizing that by disclosing to us, they're being evaluated for the purposes of the relationship, not necessarily for someone to say, oh, you're poorly rated, you're out. Or you're really well rated. Obviously, you've got margins that can be compressed, so we shouldn't be paying you as much, right? And those are the two ends of the spectrum.
I hadn't thought about that, but yeah, that's ridiculous.
Well, but it happens, and actually, so we've got success rates of getting disclosure from now companies in 130 countries that range, depending on the program, between 80 and 85%. The companies that don't disclose.
Okay, so just. You got to unpack that a little bit. How are you doing this? Because that basically is one of the biggest worries that I hear, is that they're small, they won't give us their financials. How do you do this, James, to make them feel like they can trust you with their financials?
Yeah. Well, so first of all, we have a reputation for being trustworthy, which we've built over a lot of years, and we really care about a lot. So we put a lot of time and effort and investment in our infrastructure to make sure that we can represent to both sides, individual private companies and large enterprises, that we have that we've got a platform and confidentiality and controls around all of that to protect the data. So that's one. But it gets to a little bit more of a combination of technology and personal interaction where we're communicating to the private company that there is this value in the disclosure, and that by providing the financials, they're doing something that can help their relationship with, pick the client name. And it's also important that our clients respect that the basic tenet of that communication. And we sync the messaging, of course, with our clients. So some clients will mandate that private companies disclose, but more often it's one that's encouraging them to disclose. So making sure they understand that that the data is going to be protected, that the data is not going to be used against them, but is going to be used for an analysis that helps the dialogue between them and client. And oftentimes, the result of it is that that private company gets more business or gets more assistance, even in a case where they may have weaknesses, because it puts them in a position where they're able to communicate what those weaknesses are in a proactive way, as opposed to just hoping they aren't found out. Because most smart supply chain organizations or third-party risk organizations are going to figure out that there's a challenge or a problem with the company. But if the company is able to disclose it and talk about it in a way that's constructive, that goes a lot farther. And interestingly, COVID has accelerated that dynamic, because more private companies came through COVID knowing that if they communicate openly with their clients about their needs, their challenges, how long a closure might be at a site, that kind of thing. And the more clients were communicating with their suppliers saying, this is what we actually need and when we actually need it. We're not trying to hoard inventory. We're not trying to put pressure on you that you're incapable of delivering on. That kind of communication really improved during COVID. And we're seeing that in the way suppliers will be prepared to disclose. And as I said, we've done this for hundreds of thousands of times now, from companies in 130 some odd countries. So it's a pretty well-honed process, and espousing collaboration is by far the best way of getting two parties together.
Well, I love the silver lining. There actually are lots of silver linings from the terrible times we went through together. COVID was a tough time, and it certainly did put a lot of pressure on organizations, but that is a wonderful unexpected consequence. And I think that I saw that a lot in my practice. I had, let me see, I think it was 12 weeks in a row. I had through Risk Management Association, we had conversations with over 100 third-party risk management professionals in the financial services sector. Every week, 12 weeks, we talked about what was going on. And that actually was a really good thing that was coming out of it, was this whole notion of collaboration. And I hope that continues, because these young companies that they don't have the resources or even sometimes the knowledge to be able to deliver on all fronts. Helping them is a really good idea. If they've got a great product and you like to work with them, what you don't want to have happen, and I see this all the time, people just sort of chuck it over their shoulder and say, okay, Mr. Business, you take the risk. Right. So we don't know what the risks are, so you just accept them blind. And they have particularly no incentive to actually help the organization manage risk, because their risk professionals just said, I give up. Right. And I don't think that's from a professional perspective, that is absolutely not good enough.
It's not good.
So,
and it'll start to become a competitive weapon. The private company that is prepared to disclose and engage in talking about their business is going to win more business against their competitors. So, when you get down to the various tools that a private company has, being communicative is going to be one of the really powerful ones that they've got. But we also need to recognize that not every company is going to disclose, and not every company out and get private company information on every private company. And going back to the criticality question, for a firm that has 10,000 suppliers and 750 are critical, there's a whole lot that are less critical that they may not want to implement a program to get financial health data driven by the financials. So we actually created in the last couple of years a product called HealthMark, which gives a risk indicator on companies irrespective of not having their financial statements. So that's really we use that for the longer tail of less critical suppliers. But
Yeah.
one other quick thing to note is that, one of the consequences of the COVID crisis, which is less of a silver lining, is that a lot of companies got degraded in their operational performance. And so their financial health, or our longer term measure, which we call core health, which looks at operational efficiency, that one or both of them have declined. And a lot of companies were able to access capital, particularly through COVID, through PPP funding and others, and other stimulus, that they've been able to kind of disguise the fact that they've been weakening and have been continuing to perform, but continuing to perform with a fuse life that's shortening because they're burning through the liquidity that they've got, and it's going to expose the operational problems that they have. And we're seeing that across lots and lots of industries, whereas you go upstream into the supply base, we're seeing companies severely degraded, but kind of hanging on. And really, for the next couple of years, and the macro environment today, with all the market volatility we've got, will exacerbate that. We're going to see higher default rates, and we're definitely going to see more operational degradation, because companies are still just hanging on, but just hanging on, and really have problems that they may not be able to work through.
I am so glad you brought that up. That actually intuitively, sort of that's been kind of circulating in my mind for quite a while now, James, that, with all of this special funding that was available, there were a lot of ways to paper over the cracks. But now, not only do we have all the operational degradation that took place during COVID and all the problems and, the impact on revenue and their ability to attract and retain people, we now have inflation, right? And many people that, certainly my daughter and her husband, they have never experienced inflation, right? So they are experiencing it really for the first time in their adult lifetime. And for people like myself, I have seen this movie before, right? So my husband, he was a financial analyst, and so we talk about this a lot. So I'm so glad you brought this up, because I think that financial health has been one of the top three. It's going to stay there firmly for sure, and in fact may start to be. It needs to be a leading indicator, right? Whether or not you can use financial health as an early warning system, that you need to be on top of the relationship and determine whether or not there's anything that your company needs to be doing differently, because some of your critical third parties are if they're not already in trouble, they could well be in the near future because of rising interest rates and inflation, and also, rising costs. So, they've got a lot of things coming at them at the same time. So anyhow, now I have to laugh, because you actually answered Kenya's second question without my asking, which was, how much was the criticality of the service that's being contracted? How much should it influence the analysis of the financial health? Thank you. You already answered that one. Okay, I have one here from Jeff, and he says that, you answered his second question about private companies, but he has another question. I don't know if you have anything to add on recommended practices for segmenting financial health risk. So I don't know what segmenting financial health risk exactly means. So we're going to have to sort of guess. Segmentation is, yeah, but what do you think he means by that?
Yeah, so what I hear in that question is thinking about the financial health risk of lots of suppliers, and doing it in a way that lets you think about them both individual companies, but also on more portfolio bases or segmented bases. So
good catch.
Yeah. So, and I hope that's what he meant. But what we see a lot of clients doing, once they have programs that are up and running and have, a good critical mass of ratings, is being able to not just look at the individual companies, but being able to look at the groups of companies as a whole, but also smaller portfolios, just like a financial analyst would at an asset manager. So your suppliers who are technology providers, your suppliers who provide to a particular subsidiary of yours, or to a product line, or that are managed by an individual commodity manager or risk manager. So the subgroups and what kinds of risk migration you're seeing in those subgroups. And as they roll up, how does it look as a whole? Because
Mhm.
when going out and bringing on new suppliers, you don't want to add risk in aggregate. You want to de-risk in aggregate. But if you absolutely need to work with a supplier and they are risky and add to risk or are correlated in their risk profile, you want to be aware of that, because awareness allows for programmatic risk mitigation. If you're blind to it, you
Yeah,
have no
and
idea.
monitoring, yeah, yeah, exactly. That, well, thank you very much, because I wasn't sure what that meant, and I think you're right. This portfolio approach is predicated, of course, on having a system. So a lot of people that I deal with, they don't have a system to manage third-party risk, which is kind of nuts. I mean, because it's just like, I don't know how you actually do it if you don't have a system to be able to pull things like a portfolio view, or if you want to put a certain lens on things. I mean, this is all about risk-informed decisions. That's why we do what we do.
Yeah, exactly.
And so if you don't have the data at your fingertips, I don't know how you're supposed to support, except for on a onesies basis.
Well, I mean,
No,
Linda,
yeah.
we have in our system, we have portfolio analytics for people to use, looking at the financial health or health mark exposures to groups of companies. But what we find, to your point, is interesting, is that not all clients can say, okay, and this is how much we spend with each one of these suppliers, or here are suppliers, we don't know where they're located. There's
I
so
know, it's
there's some.
like, it's kind of crazy, isn't it? It's just,
Yeah.
it makes me wonder why it's so hard to get investment for things, to like a platform, in order to be able to protect your company, because the size of the third-party portfolio, we didn't even touch on the non-vendor population, but it's the size of the overall portfolio and the number of people and parts of the organization. It dwarfs every company I've ever talked to, right? So
Sure.
the company is kind of like this big, and their extended enterprise is this big, and they've got a ton of companies they're doing business with, and they spend all the time. It's like when I first went into strategic sourcing, right? Everybody worried about budgets. Well, you know what? We're spending billions and billions and billions on third parties. Why wouldn't we want to look at that too? Right. So I was like an early stage chief procurement officer, and believe me, the savings would fall out of the sky. It's the same concept here. If you don't understand your portfolio and who you're doing business with, how in the name of goodness are you supposed to actually help the organization manage risk, except for the day you sign the contract? So, yeah. Now,
It's true.
I want to ask you, are you seeing much in the way of sort of the non-vendor component of third parties? Like a lot of times, like I come out of financial services, so you have to deal with like correspondent banking, and you have to deal with the platforms like Interact and Visa, right? Where you don't have an option. Or do you think that those ones are being, where are people monitoring the financial health on the non-vendor part of the population?
Yeah. So, we our 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 client base spans 27 some odd industries. So we're working with financial institutions of all kinds, but also manufacturing companies and services businesses, and so forth. And the largest concentration of our clients are using us for vendors, suppliers,
Mhm.
trading counterparties, third parties. But a pretty decent chunk also use us, either the same organizations or different organizations just using us to look at customer risk, or to
Mhm.
look at insurance companies, for instance, using us to evaluate the credit risk components of workers' compensation insurance or other professional liability insurance. Slip and fall insurance with workers' comp is a really good example. A
Mhm.
company that is weakening in financial health probably isn't doing the same kind of health and safety investment that they should be, and workers fall in their claims, right? I mean, it's all very connected. So
Mhm.
we definitely see people using financial health as a means to understand any counterparty that they work with. The last mile of how it's used is really about the part of the business and how they are taking that data and what decisioning they're making with the data. But it can be roundly used. And if you think of an individual company having a financial health rating, the perspective of that company all benefits from understanding the rating. Companies that buy from them, companies that sell to them, companies that lend them money, companies that
Mhm.
provide insurance, their auditors, their regulators, if they're regulated. Everyone has a perspective in on that company that can be enhanced by understanding the financial health.
I think that there's a lot we can do. People say that their program is mature, quite often. I don't believe that to be true in most cases, because these are very good examples of where we're not really doing all of our homework. So, when you look at what some of the bank failures in the US in the last, or teetering on the edge, right? It's like everybody runs for the exits at the last minute. But the truth of the matter is that you should know your third parties when what you're getting into. So, overnight lending is something that, banks do with each other. And so, or you're sending wire transfers off to somebody, or you're using some system to actually make your industry work. And when there are financial health problems in any part along the chain of relationships, and something gets stuck there, the money gets stuck there, or they can't perform their role, basically you fall on your knees.
That's right.
And a lot of these things, when you look in the rearview mirror, you could see them, right? You can see them very, very often through financial health, because basically the breadcrumbs are already there. Anyhow, I'm very passionate about this, James. So
me too.
I really, and it just boggles my mind that lots of companies don't do a better job on this, because after all, money is what makes the world go round. It just is a fact of life. And if the companies you're doing business with don't have enough of it, or don't know how to manage it properly, or their third parties are at risk of, they can't collect from their customers. Like, if you don't understand the industry sector that you are working into, because you're not there, you're not tech, perhaps because you're in healthcare, or you're, dealing with another part of the whole extended enterprise, you do need to know. Anyhow, I'm looking at
Absolutely.
the time. We're running out of time here. So I just want to ask you, Silicon Valley Bank is very, very looming large. And we did a poll, Arsoni, who works with me, he did a poll. He posted a poll for us a couple of days ago, asking, like, was this a liquidity crisis, or was it something else? And it's interesting how many people said they thought it was a liquidity crisis. It's an interesting perspective. I think there's a lot to do. Were there any warning signs from the financial side of things that you would have pointed out? It just as this one example of how people could have prevented a lot of pain.
Well, so liquidity crisis is an interesting phrase, because when there's a run on a bank, there's a liquidity crisis because the money's gone. But that's not what caused it. Right? So
Exactly.
In a case like this, the assets that Silicon Valley Bank had fall into two categories. There's the hold to maturity, which doesn't need to be marked to market, and there's the available for sale portion, which is a smaller portion but does get marked to market. And if that isn't hedged,
for non-financial people, just explain the mark to market.
Oh, sure. Just meaning that you need to evaluate what those securities are worth at any given time, and then you take a gain, or you record the gain, or you record the loss. And if you record the loss
every quarter,
right? So in a case with rising interest rates and a yield curve that's inverted, that makes the value of long-term securities less valuable. So if you bought them for 100 cents on the dollar, maybe they were worth 70 cents on the dollar. Well, then you've got a 30-cent loss. And that 30-cent loss, when you all of a sudden have to disclose it, and you didn't hedge that interest rate risk, or in SVB's case, they had, but they sold a lot of those hedges because they were good hedges and in the money, and they needed the profitability, so they sold them. So therefore, they didn't have them anymore and needed to record the losses. All of a sudden, the bank looks much weaker. And that's what happened. And then when the leading venture capital firms told their portfolio companies to yank their money out, that created a liquidity crisis. So it's sort of like saying someone was incredibly sick and died, and but that's after they got hit by the car and they were extremely sick. Like terrible things happened to them.
Yes, a painful analogy. I just wanted to touch on that because it scared a lot of people. And, in the long run, everything is about leadership. It just is. So, and leadership is really one of the reasons why you have sound financial health and why you don't. So this is a very important contribution to the overall perspective, but certainly it's not the only one when you're looking at third parties. right?
Sure.
You have to look at many, many things, but shouldn't be overlooking the financial health. Anyhow, so I also wanted to, I just wanted to talk one more time about, sort of early warning signals. Now, what happens with a company that you've rated and they go through, say, a major merger where they acquire or are acquired? What happens to the ratings then? What do
So
you do as a company?
Well, so we will re-rate the company based on the post-event financials of the business, unless they're acquired and being maintained as an independent entity, which happens a lot.
Right.
It's very situational, and it'll depend on what our client or clients want in terms of a re-rating on that company. But what we also find a lot of times is a rated company will tell their client, our client, that they are thinking about an event. Could be an acquisition. I mean, it could be that they're getting acquired. It could be that they're taking on a whole chunk of private equity. It could be a whole bunch of different things.
Mhm.
And they communicate that, but they can only communicate it if there's collaboration and communication. But
Right.
once they're doing that, they may say, "I'd like to show you my financials will look like on a pro forma basis, and we'll rate those." So we will give our clients insight into what a post-event can look like for a company, which again is all part of trying to facilitate the collaboration and the communication between the two parties.
Oh, I did not know that. That's really interesting, James, is giving a forward view when there's a major change in
And
the composition and the profile of the organization itself.
and there'll be
Now,
a lot there's going to be a lot
yeah,
more of it
yeah.
because as capital becomes less available through banks and through alternative credit providers and so forth, a lot of private companies who have been degrading and
Mhm.
whose fuse life is shortening because they're running through their cash, they're going to need to turn to things like private equity investment and M&A. So you're going to see a lot more of both of those, which will cause event risk and disruptions in people's supply chains. And the more they're able to get on top of that and understand what those suppliers are going through, the better off they're going to be.
Okay, so I just want to encourage people on the phone. You're more than welcome to join in the chat if you have specific things we haven't covered. But I will ask you about, do you provide automated alerts and whatnot where there's changes in financial condition?
Sure.
So how does
Yeah.
that work? Yeah, how does that work?
So we provide ratings alerts that are configurable by our clients who say they may say I only care about alerts when a rating moves 10 points. It's a 100
Okay.
point scale, or when it goes through a risk zone and we've got 20 points on 5 risk zones. Um, or that there's been an updated rating. So we may be on a cadence of updating private company ratings, and as soon as we have the financials and we put them through the system, then we're generating the ratings. And generally, in some cases it's people want to know the rating itself and what the change is, but also
Mhm.
our reports are designed to be guides to facilitate the conversation with the rated company, and our one report style in particular lays out the 5 most important questions to ask that supplier in a discussion with them based on the financial health changes. So oftentimes it's people want alerts in time to be able to go into a QBR or in time to be able to have a conversation with a prospective new supplier wherever they are in the RFX process.
Okay. And we actually just got a question in from Daniel. Do you provide benchmarking reports for various industries?
Yeah, so every company that is rated goes through one of 24 industry models that are all part of the system.
Mhm.
And so the rating itself is benchmarked against industry specific data with the coefficients of 73 ratios being unique to the importance of those ratios in that industry. So there's a benchmarking that is very much inherent in the analysis. In each one of the reports, we also talk about how that company looks against the leaders and laggards in its industry. And then we also have industry reports you can look at to see how certain industries are migrating in terms of risk based on the bottom up ratings of the component companies in the industry.
You are just so smart. I've learned so much from you every time I talk to you, James. I mean,
That's
I've
very
actually,
kind.
this has just been a wonderful conversation. It has just been so rich, and you've given me a lot more insight. I have one final question for you. What kind of credentials should the people on the receiving end in these organizations who are looking at your financial health ratings, do they have to have any special training to know what they're looking at?
No, they don't. Which is part of the reason that we've created these styles of reports that let anyone interact with the data. And it's a very rigorous analytical process that creates a very simple output, a 100-point
Love it.
scale. But then
Love
anyone can look at the reports and gain what they need to be able to understand the kinds of questions that they should be asking, whether they're financially trained or not.
And that's what we should be doing in third-party risk management. We should be taking all this complexity and simplifying it so that the business can make risk-informed decisions. I mean, as I said before, that is why we exist. So I'm going to wrap up here, and I want to thank you very much. As I've always been a huge fan of Report Ratings. So if
you.
anyone out there is looking for a financial health solution, risk intelligence solution, what you're hearing is actually quite unique in the marketplace, where your company is actually evaluating the financial statements to help understand the current state and predict the future, and then keep your clients informed where there have been changes in ratings. So that part about the financial statement analysis, I believe that you're unique. And I think that is really what gives your organization the lead here, is because the amount of rigor that goes into the financial ratings is not superficial by any stretch of the imagination, and can therefore be relied on. And now you're in so many countries, almost all of us deal with companies around the world. And that makes life a whole lot easier, where you don't have to go and hunt and pack for a solution in a different country. You can bring this model in. A lot of places I see there is an API that brings this information right into their third-party risk management technology solution. So it's not like you have to, necessarily do a lot of manual hunt and pack for the information you're looking for.
That's right.
Okay.
That's right.
So thank you very much, James Gellard. And
Linda, thank you.
So I appreciate the great chat, and thanks everyone for joining us today. And this recording will be available. And of course, we'll send you a copy, James. So thank you very much. Enjoyed
Linda,
it.
thank you. And thank you everyone for attending. Appreciate it.
Okay.